The euro-dollar has been performing impressively for the last few weeks, and neither the good results of the US economy or the Fed are going to weaken the currency in the short or medium term. Greg Michalowsky, Chief Currency Strategist for FXDD, thank you very much.
My pleasure.
So Greg, do you think that this trend in the euro-dollar is going to last until when?
I think it's probably near the end of its run back up to the upside. It seems like the euro versus US dollar seems to be in a up and down type of a trendy thing. It wasn't too long ago that the dollar was the stronger currency, and now the euro becomes stronger. I think fundamentally, however, the US still has an advantage over the euro, and I think that will lead to a stronger dollar soon, and then we'll see what happens after that.
Do you dare to give us a forecast for the midterm, let's say 3 months or next month?
I think initially the market may still go up a little bit, to 136 perhaps, and then start to fall down again. Somewhere, if it can get through around the 128.75 level, that's the midpoint of the move up from 2012 to 2013. So that was key support just a few weeks ago, and if it could move its way back down through that level, I think then the dollar, there's chance for further momentum in the dollar to the upside and the euro to the downside through the 128.75.
Okay, but if this may happen,
right.
Do you think that the European Central Bank would change its policy, or maybe you think that there has been all this talk about the negative deposit rates? Is it going to happen?
I think the monetary policy and central bank policy is very dependent upon what's going to happen to each individual economy. So that's what makes trying to predict what the currency rates might do particularly more difficult these days, because even the Fed and the ECB central bankers have an uncertainty as far as what may happen in the near term or medium term. We have, if the euro is going to get weaker, I think that would imply that that they're looking more toward that idea of perhaps lowering rates to negative rates. It may just be a verbal threat, and that may be enough to push the market to the downside. And then on the other side, as far as the Fed goes, if they start to taper some of the quantitative easing and stuff, that could also have an impact on the dollar in a strengthening environment. But they too are dependent upon the data. Have said that we are data dependent here. So it may be, we have a Fed meeting this week, and it may be that it's another couple Fed meetings before before we start to see some action from the Fed, in which case maybe we start to get the dollar strength toward that time.
Is it a consequence of the recovery of the U.S. economy? Is it really happening? Is it recovering?
Well, that's the $24,000 question, or the 24,000 euro question for wherever you are. It's not all that easy to figure out. But what I do know is that employment growth, as far as measured by the non-farm payrolls, was higher when the Fed initiated their $85 billion bond purchase program. If you took a 3-month average, it was averaging around 200,000 jobs at that time. The 3-month average now is in the 150s. So, it doesn't necessarily warrant that idea that the economy from an employment standpoint is strengthening at this point. So, but 1 month can change that whole perception of job growth. And that's going to change the market's mind as well at that time, because it's so dependent upon what that data it actually comes out as.
So paying great attention to the non-farm payroll results every month, right?
Absolutely. It still remains economic statistic number one, and so it has to. Traders will be paying attention to that, and any number over 200 or so, any sort of surprise that way, will get the traders thinking in terms of the Fed starting to taper their bond purchases. Anything less than 150, then all bets are off, and unfortunately, that's what we have to live with.
Okay, Greg, thank you very much.
You're welcome. Thank you.